Inventory valuation can make or break a company. It is absolutely essential that the valuation method you choose aligns with the needs of your specific business and the industry it serves. In this video, we will introduce one valuation type known as First In, First Out Valuation Method, or FIFO for short. Let's jump in. First in, first out is a method used in accounting for the valuation of inventory. While you may think of the movement of physical inventory when you hear the phrase first in, first out, this is not always true in terms of inventory valuation at an aggregate accounting level. In fact, when looking at valuation using FIFO method, one must assume that the oldest inventory is used first. What does this mean exactly? Well, assets that are produced or acquired first are sold, used, or disposed of first. With that being said, there is no direct relationship between the movement of physical assets and the valuation other than the fact that accounting assumes the oldest is used first. When looking at FIFO from a tax perspective, the method assumes that inventory with the oldest costs are shown on an income statement under cost of goods sold first. Any other inventory that is left over is paired with the most recent purchase price or production cost. So, why would an organization use FIFO? Remember, always speak with your accountant or CPA before deciding on a valuation method. In most organizations, as inventory progresses to later stages of transformation and as finished goods are removed from inventory and sold, the costs associated with the item should be acknowledged as an expense. However, in the case of FIFO, it is assumed that the cost of the oldest inventory will be recognized first. This lowers the total value of your inventory. With this in mind, there are many advantages and disadvantages of the FIFO method. One advantage is that when inflation occurs or prices are rising, the FIFO method reduces the impact of inflation and understates the value of your inventory. Of course, this also means that if prices are falling or deflation is occurring, FIFO overstates the value of your inventory. This occurs because the cost of the oldest items in your inventory. For example, during inflation, the cost of purchasing newer inventory will be higher than the cost of older inventory. Another benefit is that FIFO is probably the most used form of valuation across the global environment. One of the last benefits of first in, first out valuation is that it is a good method for reducing obsolescence of inventory because the oldest is used first. Now let's turn our attention to the disadvantages of FIFO. To do this, we will quote from an article on Investopedia entitled, "What are the disadvantages of FIFO accounting method?" You can find a link in the article below. In the article, the author, Greg DiPersio, cites two key disadvantages. The first, according to the article, is that FIFO tends to overstate gross margin, particularly during periods of high inflation, which creates misleading financial statements. Costs seem lower than they actually are, and gains seem higher than they actually are. The second disadvantage, according to the article, is that because of these high profits, a company may incur substantially higher income taxes. Let's look at an example of FIFO before we go. Let's say we purchase 100 items for $5 each, and 100 more items are purchased next for $10 each. We now have 200 items with a total value of $1,500 in inventory. Now let's say we sell 20 items for $20 each. FIFO would assign the cost of the first 20 items resold at $5. Because we are using FIFO, the cost of the first 20 items is $5 each. This means our cost of goods sold is $100, and we have a remaining value of $1,400 in inventory. After 100 items are sold, the new cost of the item would become $10 regardless of any additional inventory purchases that are made. And that's it, FIFO. Now, let's make our minds think for a second with a little challenge. If we purchase 20 items at $5 each in month 1, then in month 2 we purchase 20 items at $7 each, and finally in month 3 we purchase 20 more items at $10 each, and we sell 15 items, what would the cost be under the FIFO method and why? We look forward to hearing your answers, and we'll see you in the next lecture.